equities are telling us that the Fed is going to make a mistake. And even the Fed is saying we could make a mistake. The economy could enter into recession. We hope not. There are instances of so-called soft landings, but I would submit that housing and autos down 20% is not a soft landing. You're seeing in the sectors, as equities are broken out by something called GICS sectors. Energy, utilities, and materials are up. Now, energy and materials are value sectors, and they tend to do well in inflationary times. If we're right, and fiscal and monetary policy are both very tight and getting tighter, then at some point this is going to flip. We will flip away from this value rotation and back to growth, and it couldn't happen too soon for us, of course. On the losing side, consumer discretionary, and of course any advertising sensitive company is getting hit here, especially on the social side, and especially with the competition from TikTok. So it's hard to tell how much of this is a competitive dynamic and how much of it is an economic dynamic. It's probably both. And of course, technology has been an underperformer. Interest rates, interestingly, as the Fed has talked in a very hawkish way, meaning it will continue to tighten. The long-term Treasury yield has had trouble getting and staying above 3%. Now, in my mind, 3% Treasury yield would be consistent. See, this is the 10-year Treasury bond yield. It would be consistent with 10 years of 3 to 4% nominal GDP growth on average. So right there, unless the economy is negative, it's very unlikely, meaning economic growth, real economic growth is negative. It's very unlikely that inflation is going to be in the 3 to 4% range. So that should be reassuring to the Fed, and the yield curve, meaning the difference between long-term Treasury yields and short-term Treasury yields, that has flattened dramatically. In other words, as short rates have gone up following the Fed and anticipating the Fed, if we're thinking about the 2-year rate, the 10-year rate has not gone up that much. And so the yield curve has flattened to roughly 30 basis points, or 0.3%. That's a very flat curve, and it is typically associated either with disappointing growth impending, or lower than expected inflation, or both. And we think it will be both. And we do believe that the Fed in these next few months is going to get the message loud and clear that it cannot increase interest rates much more than it already has. We probably will see the other 50 basis points here in June, but by July, as companies are reporting earnings and talking about the future, we think the Fed will get the message. And this will be very positive for the equity markets, and this is what we're waiting for. As I always say, dark is before the dawn. We're in the bear market. Everybody knows what the problems are, and we're beginning to get signals from the marketplace that the Fed is probably going to at least start talking in a more dovish way as opposed to hawkish. We see the dollar and junk bonds and credit default swaps, all of them kind of swinging wildly in the last month, not giving us any sense of direction. We've seen commodity prices, as I mentioned, oil going back up, but not getting back to where we were when Russia invaded Ukraine. Remember, at that time, many people were expecting oil prices to go to $200 a barrel based on that supply shock, and that did not happen. So we're waiting here. I often use the word Wile E. Coyote, or the idea of Wile E. Coyote, running and running off the cliff, not realizing it until he looks down, and then boom. This reminds me very much of 1986. Yes, I did say 1986. Oil prices were stubborn, levitating. And, the cartel even had more power back then. And it levitated until it was clear that demand destruction was not going to allow for the pumping of oil at the rate OPEC and others were pumping it. I think the same thing's going to happen now, especially now that the U.S. Or oil producers can hide behind national security as they are starting to pump more oil. I think within the next year, we'll be up to an all-time high in oil production again, and we'll be perhaps we'll be the largest producer in the world once again. Now, I'd like to conclude. This is bleeding now into the innovation part of this video. I'd like to talk about Bitcoin. As I mentioned, we're launching the Bitcoin monthly, and very excited about it because we think the market needs this. And Yassine El-Mandra, who's our lead crypto analyst, leading our crypto effort, and David Puel, many of you may know him from his on-chain analytics work. He's created many metrics that many people are using these days, so we're so happy to have him on board as well. In this report, you will see that for the first time in Bitcoin's history, we've seen 9 consecutive weekly declines. And so when we first looked at that, I think the tendency was to say, that's really negative. And my question to the team was, well, could it be oversold? Could the rubber band be stretching here? Or is there something wrong? And we don't know the answer to that, so we put that in neutral category, and you'll see we'll put each of these metrics in bullish, bearish, or neutral. But we do know what happened in the last month is that Terra, the blockchain Terra, blew up, and Luna is worthless. I think I'm correct in saying that the market cap of that ecosystem at one point was around $60 billion, with a lot of well-known advocates for it. I was surprised because algorithmic stablecoins don't make any sense to me. I have a background in economics, and I think you need the backing of something in order to have a stablecoin, and this did not. And so it didn't surprise me to see the number. I think this is the number of Luna outstanding go from in the span of a week, something like 350 million to 6.5 trillion. And I think it maybe even got to 20 trillion. So that's hyperinflation. There was nothing backing it. And